A
Sure, I'm good
very
to
good
go.
evening to everyone in India, and a good afternoon and good morning to anyone who's joining us from further west. Uh, Welcome once again. Welcome to the April chapter meeting for the India chapter of the CMT Association. It is such a pleasure to have everyone join and share in the ideas that we're discussing as we work to advance the discipline of technical analysis around the world. And I bring up around the world because today, to start proceedings, before our guest for the day, Vijay Bhambwani, joins us, is another special surprise guest, the president of the board of directors of the CMT Association, wealth advisor at Dogpatch Capital, and my dear friend, Brett Vio. Brett, welcome to the chapter meeting. I'd love to invite Brett to share a few comments before we get started with the day.
Hi, Joel. Thank you very much, and thanks everyone for letting me attend the chapter meeting and view the presentation. It's fairly early over here in the morning in San Francisco, California, but I'm very happy to join and get to know you all a little bit better. And I just wanted to say hi, and I wanted to say thank you to Joel for doing such a phenomenal job, and Kazad, and also to our two co-chapter chairs, Akshay and Vishal. And I look forward to seeing you guys in Washington, D.C., just 1 week from now at our annual symposium. And I also wanted to say to everybody that, we, the CMT Association, had our inaugural India Summit in 2019 in November, and then the coronavirus pandemic happened. And it was, there were many situations around the world of potentially really good things happening that were gaining momentum, and the CMT Association in India was one of them. And so it was one of those cases, great examples of something where the pandemic really happened at the wrong time. And so I'm very excited that we may have another live event sometime soon of the scale of the CMT India Summit in 2019 again, and I will be there for sure because the first event was phenomenal. The three virtual summits that we've had, and if I'm right about that, or is it just the two? It was just the two. The first one was the next India Summit was virtual in 2020, and then we had an APAC region summit that was virtual as well. So knock on wood, hopefully we're all back in person again at a regional summit sometime in the coming months and coming year. And with that, I'll just say thank you to our speaker Vijay. So I'm very excited to hear your lecture, and thanks for everyone attending and your interest in the CMT Association. Oh, you're on mute, Joel.
Sorry about that. But thanks once again, Brett, for your time. I have one quick question for you before we let you go. We are meeting next week at the CMT Symposium this year. And obviously, the symposium is accessible online as well for all those who can't make it in person. It's free for members and candidates. What would you say you look forward to most at the symposium every year?
Well, this is the first time we've done a hybrid event. And so you have the opportunity to attend the whole thing virtually. The big advantage of attending in person, and that's the reason why I mentioned it in my comments, is attending in person has this, I hate to use the word networking because it sounds very commercial, but it has this advantage of making friends and contacts far beyond what you had imagined possible at attending one. So that's what I most look forward to again. But that being said, I think that it's really, this goes all the way back to my very first, back then, Market Technicians Association meeting in an annual meeting, was the quality of the speakers are really, it's just one after another of some of the best technical analysis presentations that you'll see. And that's really kind of overwhelmingly surprising too. So I think it's sort of both of those things. Is the quality speakers is phenomenal, and then if you have the opportunity to be in person, it's meeting people.
Wonderful. Thank you so much, Brett. And now let me invite Akshay Chinchalkar, co-chair of the CMT Association India chapter and member of the Global Board of Directors, to introduce our guest, Vijay Bhambwani, to lay some context for the session today and to get the ball rolling. Thank you so much, guys.
Thank you, Joel. Thank you, Brett. I hope you guys can hear me well. Um, I want to thank everyone who's joined us, for the CMT chapter meeting today evening. Look, I have to say that today's guest is someone that we've been meaning to get to talk to all of you for a long time, and finally, we managed to crack the code and hunt him down. It is our utmost pleasure to introduce Mr. Vijay Bhambwani, who really, on second thoughts, barely needs an introduction. Now, still for those, who are meeting Vijay for the first time and have only just been introduced to his work, he's a financial markets veteran, someone with many.
Akshay's video seems to have frozen. Um,
Now, I said this just a few seconds ago. There couldn't have been a better time to have Vijay talk to us. Look, everybody knows that commodities are in the news. The right reasons or wrong, depending on which side you're on. And I believe this trend in commodities is still in its infancy. I was looking at some historical data and I realized that when commodities move, they travel faster and longer than most people think. Now, given that, I could not have thought of anyone better than Vijay to talk to us about what that means for equities, fixed income, and currencies, as inflation has been anything but transitory, right? While central bankers' credibility is looking increasingly transitory. And I know this for a fact since I follow Vijay's work very, very closely on YouTube and other social media channels. Commodities is something that is second nature to him. So it'll be great to kind of get to know about his insights on where he thinks the markets are likely to head in the near term and further out. So without further ado, Vijay, thank you so much for consenting to talk to us today. The floor is all yours. Take it away. Thank you.
Am I audible, Akshay?
Loud and
Am
clear.
I audible to everyone?
Yes, you are. It's all good.
All right. Thank you to the CMT Association, the India chapter, for having me here today and having the pleasure and privilege of addressing everyone. Thank you, Brett, for taking the time out and joining at this early hour from California. And this is the first time I'm speaking here in this online summit. And I'm very excited to share a few insights in the limited time that I have. Now, the ideas that I wish to share with you are not limited to a trader or to somebody who's looking forward to uh, uh, making a career in the financial markets industry. It's uniform. It's going to help your career no matter what you wish to do with this information. And I always tell people that the one mistake that most financial market entrants, the newbies, make is the same mistakes that the engineers who built the Titanic made. The engineers thought by making 12 watertight steel doors, they had made or created an unsinkable ship, a great big cruise liner. They forgot one minor aspect, that water is water and it will flow freely wherever it can. Now replace the Titanic with financial markets and replace water with money. The only thing that money desires is profit, and you cannot compartmentalize it, you cannot pigeonhole it by saying, look, this amount will be in commodities, this amount will be in fixed income, such and such amount will be in equities, and the remaining in foreign exchange. Believe me when I tell you this, when money finds an opportunity in another asset class, it will flow out of the lower yielding asset into the higher potential profit yielding asset. So, fungibility of money and therefore intermarket analysis is something that you need to understand immediately. Secondly, for those of you who are aspiring to make a career out of the financial markets, do remember that this is an age of cost cutting. I am not hiring anyone right now, but if I was to hire somebody, I would rather hire a generalist as compared to a specialist. If you came to me today and said, look, I am a USD INR trader, as against somebody who says, look, I understand the correlation between commodities and currencies, commodities and equities, commodities and bonds, and commodities with Forex, I would hire the journalist immediately because I get to pay for one guy and get the services of four. So being a generalist who's able to understand the markets well, and I mean well, not just scratch the surface knowledge, you need to know your subject well. That is what will ensure tenure, longevity, and a good, productive, commercially viable career or profession in the financial markets. So do pay attention, learn all you can, and ensure that your career really, really takes off and stays high. With your permission now, I'd like to share my screen and share a small presentation that I have made for you. It's deceptively simple and at the same time absolutely relevant. Now, I want to share a few lines which I invariably begin any presentation with. Do not construe it as me trying to shove my religion or my way of life on you. The same thoughts would apply in any civilization, any ism, any religion, any culture. This is Sanskrit. It says, Murkha pujyate parivara. Even a fool is worshipped at home. Swadeshya pujyate raja. A king is worshipped in his kingdom, maybe out of fear. But vidvana sarvatra pujyate. Only a knowledgeable person is worshipped in all four directions. Now, we want to be knowledgeable so that the markets worship us. We don't want an invisible hand coming out of our tablet or laptop or a desktop computer and putting a garland around our neck. No, I'm taking the liberty, and I'm sure I can speak on behalf of all of us present here. We all love money. We want to make profits. What we want the markets to do is to reward us for our knowledge by giving us higher profits. Basically, that is what these three lines mean. The more knowledge you have, the more profitable you will be. And that's what it's all about. Now, why should we look at commodities? And if you're an equities alone or a bond trader alone or a forex trader alone, why look at intermarket analysis? Now, the pure and simple reason is, and the more you simplify finance, the more profitable you will be. That's the sum and substance of what I've learned over the last 36 years that I have been in financial markets. In people of my generation will remember Manmohan Desai movie called Amar Akbar Anthony. And there was a very popular song, My Name is Anthony Gonzalez, where Mr. Amitabh Bachchan comes out of an Easter egg and he starts off with some mumbo jumbo by the hemoglobin of the atmospheric pressure in the country. All right. Now, what is by the hemoglobin of the atmospheric pressure in the country? It is garble, gobbledygook, right? Now, we all were in college. As old as I appear, I was young once and I went to college, and boys will be boys, and we liked a girl, said, hey, I like this girl. How do I impress her? There was always a wise guy who said, speak something rather complicated sounding, say it fast, and sound confident. The finance market and the financial markets industry, financial research industry revels in making simple things sound complicated. So, a good writer, as I learned from many editors who I worked under as a guest columnist, told me the beauty of trying to convey your idea is if your maidservant reads your column in a newspaper and she understands it, you've achieved what you set out to do. So always try to simplify your thought process because simplicity is the essence of beauty and profitability. Now, the simplest part about this argument is that commodities are raw materials for companies to make finished goods. And if commodity prices go higher, corporate profitability will be directly impacted, which means equity markets will feel the impact almost immediately. Now, commodity inflation will also trigger movements in the forex peg of a country. And because the forex market is very closely knit with the bond yields, the forex and the bond markets will move. Now, what you are seeing in the world around you is Russia using natural gas as a geopolitical bargaining chip. Call it weaponizing of natural gas, call it whatever you want. But the farmers are cribbing. For those of you who don't know your commodities well, you cannot make fertilizers without natural gas. Now that natural gas is trading at probably 200% of what it normally trades at this time of the year, the input cost of the fertilizer industry has jumped. So, right now, if you were to buy a fertilizer stock, you'll probably be buying at a very atrocious price. If you were an equity research analyst who was recommending a fertilizer stock, you would probably be making a grave mistake. And believe me, your boss is not forgiving on appraisal day. Each and every mistake is amplified and presented to you. So it actually pays to know your onions, so to say. Now, is specialization possible? Yes, it's always possible. But like I said, money, like the engineers who built the Titanic, likes to move around. It wants to move out of currencies into commodities, out of commodities into bonds, out of bonds into equities, or various permutations and combinations. Maybe two asset classes at a time, maybe three, maybe even all four. So you should be able to smell out by using data. It can't be gut feeling, it has to be backed by data, where money is flowing out of and where money is flowing into. And then it becomes a simple case of follow the leader, take your own money out of assets which are going to fall because money is exiting, and jump into assets which are rising because money is flowing in. All right. Now, the world around us itself is changing. And if you are looking at commodity markets, you cannot ignore the geopolitical situation at the ground level worldwide. Now, what was happening pre Brexit? What was impacting our capital markets, India specific or even Asia specific? The primary market that influenced the global markets was US, and then came United Kingdom, Germany being the largest and the most robust economy in Europe. Japan was very clearly the Asia Pacific leader, and France as one of the four large economies in the world, and of course, a major European economy. Now, USA obviously directly impacts market sentiments in commodities because hedge funds, who are known to have more money than God, can swing commodity prices with the sheer amount of money that they can deploy in the markets. Then, of course, currencies as also equities. Now, the UK, United Kingdom, used to determine the London Interbank Offer Rate, LIBOR. The London's Metal Exchange, the LME, used to impact prices in India on the multi commodity exchange because of the inventory that it disclosed every afternoon at 2:30 p.m. of the base metals or industrial metals that are quoted on the MCX. And then your AM and PM, which is morning and evening gold fix on the London Bullion Association. So you basically had a lot of influence coming in from the overseas markets, and our commodity markets used to make adjustments time and again for these prices. If you didn't know that the London's Metal Exchange disclosed its inventory in the afternoon every day, you would be scratching your head and saying, "Boss, I don't know why at a fixed time every afternoon aluminium, copper, lead, nickel, and zinc, which are the five industrial commodities traded on the multi commodity exchange, are going crazy." And then because aluminium is going crazy, Hindalco's share price is going crazy, National Aluminium is going haywire, you know. And if copper is moving, I don't know why Hindustan Copper is going wild and why Vedanta is turning crazy. So we are going to learn why. Now, in the post Brexit scenario, London is losing its prima donna or numero uno or number one status as an influencer or trendsetter or peg fixer, right? Peg is the price that it is set out or announced by the London Bullion Merchants Association, or LIBOR, which is announced, or the AM fix or PM fix. So, post Brexit, England will stop having the kind of hold that it had earlier, and it will be the US market which might continue to dominate the global market and set those prices. And European nations who were holding the inventory of base metals or even some amount of bullion with the British are expected to slowly but surely move away from the old arrangement. So you need to be pretty flexible in your approach. You need to keep a certain amount of leeway for human tendencies to evolve over time. And of course, the Eastern European situation where the Russia versus Ukraine war isn't helping matters get any more easier. So guidance from USA will continue to be a prime determinator. In the Asian markets, we are going to have Singapore, which will be a significant determinator of prices. You're already used to the idea of all frontline media channels in India starting with the SGX Nifty. All right. SGX is the Singapore exchange. Now, why is Singapore getting to be so important? Because, like it or not, majority of our NDF transactions are taking place in Singapore, where Asia is concerned. So even though there's no delivery taking place there, the fact remains that there's a lot of trader interest. And a lot of Indian money is also being traded there. That let's be a bit realistic here. The other factor for commodity market watchers will be China, because China consumes 1/5 of all industrial metals, and they do tend to be swing consumers of commodities. So whatever China does will impact commodity prices, and commodity prices, like I've told you, will impact other equity, forex, and bond markets. Now, the compartmentalized approach of analyzing financial markets have not worked in the past and will not work in the future. Global markets are increasingly interlinked due to the cash carry considerations. Now, what is the cash carry consideration? If a country A has an interest rate of 1%, and if country B is offering an interest rate of 10%, and if country B is a reasonably safe and solid investment destination with a good legal framework and good investor redressal complaint redressal system in place, there is no harm. As a matter of fact, there is an arbitrage opportunity by borrowing money from country A, which lends you money at 1%, transferring it to country B, where you're getting 10%, and thereby make a hypothetical arbitrage profit of 9%. Then, of course, there are a lot of currency risks and two-way remittance charges, etc., etc. But that can be hedged. So, to keep the long story short, Commodity markets are interlinked worldwide because cash carry considerations will mean that international arbitrage will happen. Now, in a radar sensitive market scenario, where slight recalibration of factors result in dynamic shift in domestic market asset prices, you cannot ignore the international commodity markets because you will then be caught on the wrong foot, you will be caught unawares, and you will not know what hit you. Now, intermarket factor. Whenever you have comparative or relative analysis between different asset classes, it gives you an edge over the others. And especially if you're looking forward to making a career in the financial markets as a research analyst, you will know that you will be decades ahead of the other guy. Now, since hard assets in India find price discovery coming in from the overseas markets, you are required to watch international financial markets in your routine life. Now, the direct correlation coefficient between commodity prices and equity markets. Now, let's take a company called Hindalco. First of all, as a guy who's seeking price direction of an equity stock versus the commodity that you're watching, you need to know whether the commodity is a finished product of that company or is it the raw material of that company. To that extent, I would say let's not take only Hindalco. Let's also take TTK Limited, TTK Prestige. You know, the guys who make our pressure cookers, that very popular jingle, जो बीवी से करे प्यार वो prestige से कैसे करे इनकार, right? Now, both these companies, Hindalco, Hindustan Aluminium Company, and TTK Prestige, have one common factor. They deal in aluminium, but that's where the similarity ends. It's a triangle, right? Aluminium being the apex, Hindalco being a producer miner of aluminium, and TTK Prestige being a consumer of aluminium. So, for Hindalco, it is in the company's interest to see aluminium prices move up. And for TTK Prestige, as a consumer, it is in their interest to see the price of aluminium come down. So, is it possible, as a really street smart research analyst, to say, okay, there's a war in Ukraine, aluminium prices shot through the roof from 250 rupees a kilo to 330 rupees a kilo. So, Hindalco's share price will go up and TTK Prestige's share price will go down? I would say yes. You don't have one trade, you have two trades: long Hindalco, short TTK Prestige. So I'm going to share a chart with you. It's a dated chart, but I assure you, if you were to do this even today on any charting platform, you will see the same results. The candlestick chart is of Hindalco, and the blue line is the line chart of MCX aluminium. You can see that the prices are almost moving in lockstep. If you've seen today's equity markets, you will realize that aluminium prices, as compared to 3:30 p.m. closing yesterday, are lower today, and Hindalco has fallen in double digits. So, the beauty of the commodity markets here is that they start at 9 a.m. sharp. There is no such thing as a pre open. They actually start trading at 9. Our equity markets hypothetically start at 9, but that's pre open. Your actual terminal comes to life only at 9:15. So you need to ask yourself this question. Between 9 and 9:15, I have 15 minutes to see where aluminium, copper, nickel, crude, natural gas are trading. Can I not take a trade or recommend my clients a trade in the commodity that has moved substantially as compared to yesterday's equity market closing time prices at 3:30 p.m. IST? The answer is a resounding yes. That's precisely what savvy traders do. It's not rocket science. They're basically looking at where people are going to be negatively or positively surprised. If people are going to be negatively surprised, go short. If there's a positive surprise waiting for him, go long. Now let's take a look at ONGC versus crude oil. I told you you need to first differentiate whether the commodity is a raw material or a finished product of a company. Now, let's understand the business of ONGC. By ONGC, I mean Oil and Natural Gas Commission. It's one of the Navratnas of the government of India. ONGC gets a commission per barrel of crude oil that it imports from abroad, and it is paid commission not flat per barrel, but the price or the value per barrel. So I can assure you that as a chairman of ONGC, in spite of knowing that rising oil prices are bad for inflation and bad for the country because we are net importers of oil, I would, as a chairman, would be praying fervently for oil prices to go up because my commission income from the government of India will rise with every dollar rise in crude oil per barrel. So you can see the candlestick chart is of ONGC and the line chart is of WTI crude on the MCX, the multi commodity exchange. It is almost invariably in lockstep, barring the last 2 months. And this is a dated chart. This is 2017 and 18. There were some corporate problems because of which ONGC's stock price moved away from crude oil prices. But then that's in the geopolitical domain rather than, or political domain rather than the technical aspect. But prior to that, if you were to see, all you needed was the price of crude oil to tell you which way is ONGC headed. Now, I know as a speaker, you would always want or seek something to be left on the table which will give you a little bit of excitement. By excitement, look, I'm a 56-year-old guy. I don't get excited by a whole lot of things, but I do get excited when I get an SMS from my bank saying, look, we've deposited an X amount of money into your account from XYZ person. So that gives you a little bit of a zing. Oh, wow, today's a nice day. I got some money. So let me leave something on the table for you. Watch this for at least 8 to 10 trading sessions before you put your real money there. And I'm backing this up with my reputation. Watch the last 45 minutes of price action of ONGC. Our equity markets will shut at 3:30 p.m. IST, but our commodity markets will be on till 11:30 p.m. in the summertime and wintertime, 11:55 p.m. Right? On at least 6 out of 10 trading sessions, if ONGC is firm in the last 45 minutes of trade on the National Stock Exchange, I can assure you on 6 times out of 10, the price of crude oil will go up in the US trading hours on that particular day, and therefore you will get ample opportunities to go long on the multi commodities exchange past 7:30 or 8 p.m. depending on whether it's summer or winter time and when the US markets open. I've tried this, it works. But like I said, 6 times out of 10, you need to have your trade setups in place. And this is nothing but pure and simple intermarket analysis, because I asked the erstwhile chairman of ONGC, who I met for a walk in the park close to the garden where I stay. He said, Vijay, it's a misconception that government organizations are lethargic, non-profitable, inefficient, and incompetent users of natural resources that are given to them. We actually know our onions pretty well. It's other reasons that result in lower profitability. So I asked him how. He said, look, we guys are so sharp, our trading desks are so sharp. They know, they can smell the salt in the wind and say what kind of a storm is coming. So our hedging is so good that we can tell you 3 months from now what the crude oil prices will be, with a slight amount of leeway, of course. So when the ONGC share price is trading in the last 45 minutes, that's taking into account the data of all the hedging and all the trading desk that is telling the markets that this is something we expect the crude oil to do tonight in the US trading session, which is why 6 times out of 10, this correlation works. Now let's take the other extreme. ONGC makes money by importing crude and earning a commission per barrel of crude oil that comes in. Now let's take Indian Oil Corporation, or IOC, another Navratna, right? Now this company, in addition to importing oil where it gets commission, also runs refineries and fuel pumps, petrol pumps, right? Now, the problem with OMCs, or oil marketing companies, in this country is that the prices at the pump are not allowed to fluctuate as fast as prices move in the international commodity markets. Especially if it's a politically sensitive time like elections or high inflationary periods, prices at the pump are kept low, and oil marketing companies' cash flows are negatively impacted. So, where the chairman of ONGC is praying for higher crude oil prices, the chairman of Indian Oil Corporation is praying for lower crude oil prices, right? So, is it possible? Is it possible for you to see the crude oil prices jumping through the roof in the US market hours, by which time the Indian markets has shut already a few hours ago? Is it possible for you to grab ONGC on the long side at open and short IOC on the open itself and make money both ways? I would say a good probability exists. Because if oil really, really jumps high, which you would have seen in the Ukraine war time after 24th of February 2022, both oil and natural gas have literally been making traders dance, right? You would see this correlation working beautifully well. And as crude oil appears a little sluggish now, you will see sluggishness in ONGC come into play. A couple of days ago, I saw an inverted hammer on the daily share price of ONGC. It's not surprising. Crude, I'm talking of WTI because we in India happen to deal in WTI rather than Brent. So WTI made a peak at somewhere around $130 a barrel and hasn't been moving up since then. And ONGC, not surprisingly, is looking top heavy. So is there a trade here? Yes, there is. Now, for how currency markets impact the equity markets and why. I believe in what is I call a 360-degree worldview of financial markets. I would rather have as many variables worked out in my mind before I put in my own money as a prop trader and not being caught by unpleasant surprise. And that also gives you comfort and it's a staying power in a trade that you've done your homework. Now, here again, the currency markets in this country open at 9 a.m. sharp, and this is not just pre open trade, this is the trade. Equity markets, on the other hand, open at 9:15. So you have a 15-minute window period to know what's happening. Now, since independence, India has always been a net importer and therefore is very sensitive about the rupee dollar peg. All right. When the US dollar goes up extremely sharply, the market tends to get a little jittery. Now, this is the candlestick chart of the Nifty 50 versus a line chart of the USD INR on the multi commodities exchange. I mean, the National Stock Exchange. I beg your pardon, right? But this is very generic. I want you to get a little more specific. Back in the day when I started in 1986, there was no Google, no internet, no cell phone, no SMS, and no WhatsApp. If we wanted to find something out, we had to do a lot of digging. But the present generation has so much going for it. You can Google search this. Find out the top 10 or 15 companies listed on our exchanges which are nursing a lot of US dollar debt. All right. Now, this is a lesson that I learned from trading through the 1997 1998 Southeast Asian currency crisis. There are some lessons that you learn only by getting punched in the teeth. All right. And losing a few teeth, of course. So, these lessons that I'm sharing with you now, I learned in the 97 98 crisis, the Southeast Asian currency crisis, by losing a lot of my teeth. All right. So, when the country's currency peg falls against the dollar, the debt that it nurses becomes that much more expensive. So repayment is a few years away, but servicing the debt by what is known as interest payments also becomes a lot more difficult. Find those 10, 15 top companies which are nursing dollar denominated debt and watch what happens between 9 and 9:15 to the USD INR. If the USD INR is opening more than 0.5% higher as compared to yesterday's closing, and when I say closing, I don't mean 5 p.m. because our currency markets shut at 5 p.m. No. I'm talking of closing of the equity markets at 3:30 because up to 3:30, systems trades, algo trades, program trades are looking at the currency peg prevalent at 3:30 p.m. Right? So I want you to make a note of where the USD INR was trading up to 3:30 p.m. yesterday, and if it opens more than 0.5% higher than yesterday's 3:30 levels, try and short as many of those top 10 companies with the highest dollar denominated debt. Let me know how it goes. Try this as a mock trade, a paper trade, or a pencil trade, whatever you want to call this. Do it for 10 days. Monitor all those top 10 stocks with highest forex debt. Tell me how it goes. I can assure you, more than 6 times out of 10, you're going to make money. And I can tell you that these are very good odds. So, looking at any market in isolation is like trying to cross the street with one eye closed. Sure, you'll get across, but you'll always be jittery because you're not looking at things in three-dimensional view. It's a unidimensional view. Your career can't really go very far when you have a unidimensional view. Now let's take a look at a stock which is an investor's darling. It's a blue chip. This again is a 2017-18 chart of a company called Pidilite, FII's favorite, foreign investment institutions. Now, Pidilite makes epoxy-based adhesives, and they are obtained from petrochemicals. So the candlestick chart is of Pidilite, and the blue line chart is of MCX, Western Texas Intermediate Grade Crude Oil. You can see that whenever the crude oil prices are jumping, Pidilite share price is falling because crude-based products are its raw materials. Same would be the case of aluminum prices going up with TTK Prestige. Its raw material price is going up. So here Pidilite tends to fall whenever crude oil jumps. In this particular period, if you would like to do a little bit of homework in 2017 and 18, you can put in a third element here, the USD INR. You will realize that the USD INR was also firming up. So what was happening was Because the USD INR was firming up, the dollar was getting stronger against the rupee, oil prices were going up in the market, and the landed price were coming in even more expensive because our currency was getting weaker. The importers were facing a double whammy. And the stock market was telling you, hey boy, Pidilite can't go up. Number one, raw material prices are going up. Number two, landed cost of raw material is going even higher because of the currency factor. And there's no way this company is going to make too much money. All right. So as you can see, all these asset classes are actually married to each other. They are in bed with each other at all the times. So I would feel very sorry for any guy who comes to me for a job and says, I'm a very good equity research analyst. I don't want you. I want a very good equity, currency, commodity, and bond market analyst because he knows what's happening around the world. So, what happens broadly as an interrelation between commodities and equities? If oil is up, companies that are manufacturing plastics, polymers, adhesives, oil paints, their stocks will go down and vice versa. If natural gas prices are going up, fertilizer companies' stocks are going down and vice versa. If prices of cotton are going up, garment manufacturing companies' stocks are going down and vice versa. If you remember something, in the budget of 2018, which also happened to be the last budget in which structural reforms could be announced before the 2019 general elections in India, you have to understand the electoral code of conduct and you have to understand economics and politics if you want to be a good trader, because a 360-degree worldview means that you're taking all variables into account. The Election Commission in this country does not allow any significant announcements or reforms to be made in the budget presented in the election year because the incumbent party that is presenting the budget may lose the election and the winning party that comes in might undo the proposals of the budget and present a new budget itself. So whenever there's an election, and now it will be in 2024, mark my words, on 1st of February or whenever it is that the budget is presented in 2024, there will be no earth-shaking reforms. It can only be a vote on account budget where the government will say, this is our expense, this is where we are going to fund that expense from, and that's it. Only after the elections, there will be a second budget because the government is continuing. So in 2018, that was the last time the government could dole out anything. And the one thing that at that point in time, the current prevalent the finance minister, the late Mr. Arun Jaitley, shook the earth from under my feet by raising the MSP or the minimum support price. This is the price below which you cannot pay a farmer or there will be strict legal action taken against you. He raised the price of cotton, the MSP price of cotton, by a straight 35%. Now the farmer is going to tell any company that wants cotton, do you want to go to jail by paying me less? Look, the budget is law now. Pay me 35% more. The world's largest denim maker is Arvind Mills, Ahmedabad-based company. It signs forward contracts to companies that it sells denim fabric to for many, many quarters in advance, with the price being predetermined. Now, the finance minister has raised the MSP of 35% by 35%. Arvind is bound to honor its commitment to the international US and European companies to supply denim at a predetermined price. Please take the time out after this presentation is over to see what happened starting from 1st of February, the date on which the budget was presented, to the stock price of Arvind Limited. It crashed. The only reason why commodity, cotton, shot through the roof because MSP was increased. All right. So I feel sorry for anyone who says, it's not my business to watch cotton prices, but I am a cotton garments research analyst. You can't do that. I'm sorry. So I am done with my presentation. It was a brief one. I do hope and believe that I've added some value to your thought process. It would be great if you could go home, do some homework, and start to think along these lines. And like I said, for the next 10 days, take a piece of paper and pencil and do some mock trades. I'm floating around in Siberia on social media. Give me a shout, good, bad, ugly, whatever feedback that you have for me, I'll take it gladly because I know what I'm talking about and I'm always glad to help. Thank you, Akshay.
Thank you, Vijay. Are you able to hear me clearly?
Loud and clear.
So, sometimes going back to the basics, is a great idea. And oftentimes, in my personal experience, I walked into a room thinking, oh, this should be fairly obvious, only to realize that it wasn't as obvious as I thought it was going to be. And the kind of stuff that you showed us today, has given me that realization again. So I mean, sometimes you just need to open your eyes and see, look out for all the simple stuff that's out there but is easy to miss unless you really keep your eyes and ears open. So Vijay, thank you so much. I think if Kazad's on the call, are we supposed to have the Q&A on the Discord channel, the networking channel?
Yes, so Vijay, if you'd be kind enough to answer a few questions from our audience, including myself, we'd love to have you back on Discord in the networking channel. So everyone, whoever wants to join us for the Q&A networking session, if you have questions for Vijay, Brett, ourselves, anything, please join us back on Discord under the chapter meeting networking section. And we'll
Oh,
see everyone there.
Kaizad, I'm not on
Yep.
Discord.
Yeah, I was about to bring that up.
Okay.
So for today's chapter meeting, let's have the questions here itself. Akshay, what we'll do is we'll relay the questions that are coming in from Discord onto the private chat here. So if you go to the
Sure.
private chat, you'll see the questions. One of them has already come in from Jason.
Okay, so sorry, Joel, I missed the last part. What channel do you want me to go on?
Not on Discord, Akshay, on
I'll
StreamYard
relay the
itself,
questions.
in the
Oh, sure,
private
sure,
chat.
sure.
I'll relay the
Okay,
questions
so
from Discord. If any.
we've got one question, Vijay. I mean, you talked about money flowing from one asset class to another, depending on where it thinks it can find most value. And the question there is, if the money in the commodity markets is purely speculative, and this whole inflation-driven trade were to unwind, because some people think it's kind of top-heavy and certain markets are overstretched because most of the Fed's aggression in terms of coming rate hikes is already out there. I mean, I don't know how much of an upside surprise there is to people thinking the Fed is going to pull a rabbit out of the hat from where they currently are. And they've made it very obvious that inflation is a monster that they have to fight and fight hard. So, given that, what are some of the areas that, market participants need to track very closely to be close to the exit door in case things don't turn out the way we expect them to? And also, as a follow-up question, if you can also explain the relationship between paper contracts that are traded versus physical delivery, that can also help.
All right. Now, Akshay, I remember talking about a 360-degree worldview. All right. So it's not as easy as I made it out to be. The presentation was very easy. For example, I call what I'm telling you about. I call this my gallery. Gallery because there are pictures of people involved there. So before I start to look at the prices of crude oil, I look at the pictures of all these guys. Now these are people whose statements make a difference. There's a gentleman, Mr. Chakib Khalil. the erstwhile oil minister of Algeria,
Correct.
Mr. Ali Al Naimi, up to a while ago, while he was still relevant, Mr. Zaki Yamani, all right, Nicolas Maduro, Rafael Ramirez. Now, when these guys talk, it's seldom without a reason. If you're looking at the Gulf of Hormuz and you see the Iranian Navy saying, "Oh, we've planted underwater mines here," you know what's happening. Crude oil is going to go up there, right? Where commodity trading in India being thin is concerned, yes, it is thin in industrial metals. It is relatively thin in gold and silver also. But look at the price and contracts traded in crude oil and natural gas. On a good day, you'll find 150, 200, 250,000 contracts of 100 barrels each traded in crude. 150,000 contracts of natural gas are almost daily affair. I'm talking of futures. Options are even higher because that's where the action is. That's where people are thinking that there is a non-linear payoff in options and therefore it's easier. That's where they go out there and make more mistakes. So I think what you need to do is see three elements. Number one, any commodity will have three types of premium built into it. One is the speculative premium, all right, which is the basis. The other is the geopolitical premium. So US refuses to sign a nuclear treaty with Iran. Okay, that's geopolitical. And the third is terror premium. Up to some years ago, there was an organization called ISIS. All right, they would go out there and raid a crude oil well and say, okay, we control this well now. And even if we sell oil at $20 a barrel, we don't really care. It's 100% profit for us. All right. So whenever there was any kind of terror attack, for example, the attack on London in 2007, if I'm not mistaken, right? 9/11, right? So whenever these kind of incidences occur, there is a huge expansion in one or more or maybe all types of premium. I believe our after the Ukraine war, there is a minimum of 20 to $25 premium built into the price of oil, and what you are seeing now is part of that premium getting peeled off.
I see.
And should WTI oil start falling, you can see lower tops formation on crude oil charts on both WTI and the Western Texas Intermediate. I mean the Brent grade. So if you start seeing crude oil start trading in double digits, right below 100, you can remain assured that the sheen is off. All right. And the one thing about markets is behavioral science tells you that human beings tend to focus on recent events. This is called the recency bias.
Correct.
So you forget that your younger sister had torn your school textbook 20 years ago, but she tied you a Rakhi today and you feel nothing but love for her, so you give her a little bit of cash as kharchi. Recency bias. So whenever ISIS used to put up a video of beheading a guy, markets used to fall here. But 3, 4, 5, 10 times it happened, and markets said, okay, let's focus on more recent events. This is very far off. Do you even remember what happened on 15th August 2021? The Taliban took over Afghanistan on 15th August, on our Independence Day. You've forgotten it. It's in our backyard, right?
Yeah.
You're more interested in more recent things. So the commodity markets will take a while, but recency bias will kick in. And what I call pro-cyclicality, which is established economic phenomena. Pro-cyclicality is when hard asset or commodity prices move in tandem with the real economy, versus counter-cyclicality when the real economy is going X, the commodity market is going Y direction, right? So we've seen counter-cyclicality for 2 years thanks to currency printing. It's about time now pro-cyclicality comes in. And I would be fairly surprised if commodity prices went up more than 10-15% from here.
That's interesting. Another very interesting question from one of our participants is about the number of hours that commodities on the MCX trade. So roughly about 15 hours in a day. In your experience, have you seen certain times during the day when you can catch swings better than average? I mean, are there some
Yes,
times where liquidity is probably more, so slippage is low? I mean, have you seen any such phenomenon?
Yes, I have. That's a great question, Akshay. As a matter of fact, on my own YouTube channel, I uploaded a video about what are the best times to trade in Indian equity markets, saying these and these hours are better than the others, right? So, 15 hours of day can be backbreaking for a trader, right? But fine tuning your entry and exit timings means you can still get time for that 1 hour swim or a walk or a jog or your home gym, all right? Let's face it, Indian markets don't really have price discovery mechanism of its own unless you're talking about agri commodity markets, and agri markets is what 5%, 7% of the turnover. All right. The hard assets, the non-perishables is where the volumes are. And those take guidance from the European markets, which open well after 11 a.m., and primarily from the US market, which open after sundown. Now, where volumes are concerned on the MCX, at least two-thirds of your volumes will come in only after the US markets open,
Of course.
right? So, if you want to trade even earlier than the US market, do note that at 2:30 p.m., depending on summer or winter time, the London's Metal Exchange will give you inventory levels of aluminium, copper, lead, nickel, and zinc. Now, if the inventory is higher, prices will fall temporarily, marginally, and vice versa. So you'll get a little bit of a pop here and there. All right. The London AM PM gold fix. All right. That's when you'll get a little bit of a pop in the morning before the US markets open in gold and silver. On Wednesdays, 9 p.m. India time in winter, the US will announce its inventory of crude oil. And on Thursday, natural gas storage. So you'll get some pop there on Wednesdays in crude oil and Thursdays in natural gas. So these are times where opportunities will come to the savvy, knowledgeable trader and put some food on your table. But by and large, I have found that majority of trading profits from commodity markets come well after 7:30 p.m.
I would agree. I started my career in commodities when the MCX and the NCDEX went live. I think it was 2004.
Yes.
And since then, the one thing that I've seen consistently is that once US markets open, you see a lot of movement in commodities, like you rightly said. So that hasn't changed and is unlikely to change going forward. Now, I have one question of my own. We are now seeing an interesting cocktail of movements in the market. So commodities are going parabolic. The dollar seems to be moving in the same direction. What's the message that you get with so many years of experience? Do you think a black swan type of an event is around the corner? What are the markets really trying to tell us? Because historically, probably the first thing that we learn when we start doing intermarket analysis is that largely, the dollar moves inversely to the trend in commodities, but that's clearly not been happening. Call it Ukraine leading into that or something else, but something's going awry, and maybe the market has those subtle hints that are trying to kind of tell us what to expect. What's your take on all of these undercurrents and traditional correlations really going out of whack?
Akshay, there's one undeniable aspect in the money markets. And for those who understand Hindi, it's an old saying, jiski danda, jiska lathi uska bhains. The guy who wields the stick will drive the buffalo home, right? Money markets are no different. The guy, Tony Stark said this in Iron Man, peace is about having a bigger gun. right?
Correct.
So the guy who has the money will call the shots. Look at where our base metals are primarily coming from. Latin America, right? This is something, since you and me are connected on social media, I keep posting, watch Latin
You write a
America.
lot about LATAM and what's happening there.
Yeah.
Correct.
Yeah. Now, what happens is these countries are not exactly what you would call affluent countries, rich
Yeah.
countries. They also have a lot of dollar denominated debt. All right. Now, seeing back what I saw in 1997 98, when countries that had natural resources but they could not repay their international debt, they had to offload their natural resources maybe at a bargain basement distress levels to repay their debt. And as the old saying goes in commodity markets, the cure for high commodity prices is high commodity prices,
Correct.
right? So sellers will start, I'm sorry, sellers will start to come out and encash their chips because they still have to repay and service their dollar denominated debt. Look at Russia. It's willing to sell its crude oil delivery at Singapore. Why Singapore? Because insurance companies won't allow a shipping agency to send any tanker to a war zone because your insurance is void, you know?
Correct.
So you're getting delivery ex Singapore at $30 discount to a barrel. Abu Dhabi is very openly known to have gone against Saudi Arabia in the OPEC Plus meeting a couple of months ago. Why? Because we want money. We've provided so much of social stimulus during the COVID pandemic, and we have only natural gas and crude oil to sell. We have nothing else to sell. How do you raise cash? By selling what you have. And this selling can bring down prices. Look at what's happening in Peru. Look at what's happening in Chile, right? Socialist presidents coming in, they thought they could dictate terms and say, we are going to raise base metal prices from our mines, or we're going to cancel American companies' mining licenses. But within 6 months, they're rubbing their nose in the sand,
Absolutely.
right? So there's a lot of things going on behind the scenes, and the guy who's wielding the stick is a guy who's having a wad of currency, or rather a truckload of currency, and saying, look, I want to buy, but at my price. And those prices happen to be lower. The other aspect that I think is happening is that you're seeing a retail guy fight back in the market thanks to Reddit or whatnot, the retail revolution, as it is called in the US. A short squeeze on GameStop and short squeeze on silver, etc., etc.
That reminds me, Vijay, Robinhood got listed with so much fanfare, and it's down the sinkhole now. So I
Right.
think the retail revolution was just a flash in the pan moment.
Yeah. So I think talking to people in the parks in the morning, or in my club bar in the night, or meeting my friends and talking to them. I chat a lot with a lot of people on video chats, thanks to it being free now. So I talk to a lot of people, and I think the one segment of people that's getting angry, is getting restless, is the guy with a lot of money. From 2018 onwards, your bond yields have been negative, or
Yeah.
in case they are positive, if you adjust for inflation adjusted return, they are either zero or they are negative, right? Your real effective interest rate, a post inflation adjustment. Now, this guy is saying, look, you want my money for whatever reason, right? Helicopter money, social welfare, whatnot. At least give me a positive rate of return,
Absolutely.
right? So, what happens if he suddenly says, I'm not going to write out checks anymore? Or I might just trickle down my checks to 50% of what I used to give you. You suddenly have the biggest borrowers, which is the state, requiring to borrow money at higher and higher rates of interest.
Correct. Correct.
So people are
You know,
looking at interest rates only from the point of view of the borrower. That's what our textbooks have taught us in school. Lower interest rates are good for the stock market. Have you asked the guy who's writing out a check?
correct. Why would anyone be motivated to write a check when he's not getting anything in return? That one question has puzzled me for so long.
Exactly. So now, up to a couple of months ago, you had $19 trillion in negative yielding bonds. which has
Globally.
now come down globally. Now it's come down to less than $10 trillion because bond yields are now going where they are going. Check them out. I think this guy, the guy who writes out checks, is going to get angry pretty soon. And
I've
that's your black swan event.
yeah, that's what I fear. I was looking at the chart of the 10-year yield in the US. It's in the news for right reasons or wrong. But I remember, in the early 70s, I think it topped out at 14%. It came all the way down to 0.5%, and now it's kind of hitting 3% as we speak. But do you think that bond bull market, whatever 30-year worth of bullishness in bonds, do you think that has finally come to an end? Have we made a generational low at 0.5%?
Well,
Is there a case to be made? It's the billion-dollar question, Vijay. I'm sure you know.
yeah, I completely agree. But the way a US investor looks at the bond market versus I, as an Indian investor, look at the bond market, I do invest in sovereign bonds, by the way.
Yeah.
I look at bonds with a purely different perspective. And this is a perspective we share in the morning walks with our friends. Where do you put your money where it doesn't go down the gutter? I'm not looking at yields. I put it in government bonds. So my friends asked me, why government bonds? They're so unexciting. I said, look, there's only one guy who has the authority to print currency. In case push comes to shove, only the government can print currency and give you back money for the bond. It will be eroded of its purchasing power for sure. But would you rather put it in those 6 debt schemes of Franklin Templeton where you got nothing?
Obviously not.
Or you put it in government debt where you're getting 7.25% with possibility of capital erosion where you get something? And the sovereign debt cannot be defaulted on because your sovereign rating goes down the gutter.
Correct.
Right?
Correct.
So when we guys in Asia are investing money in the bond market, we are actually seeking places to hide, to put money for my grandchildren, not necessarily for my children. Right? So I'm not sure as an American I would think this way. Right? So we guys in Asia look at the bond market for a purely different reason. And to that extent, it's a little difficult for me to answer this question from the US perspective, frankly.
No, I'm sure Brett can kind of give us like an American perspective.
Sure. I'm thinking of the old saying, don't fight the Fed. And it has, over the course of my career, has proved true. That yes, you're correct. It's the million-dollar question. And we here in the United States are very focused on whether or not there's a secular change in the direction of interest rates. But that being said, and what Vijay just said is true, is that there's a different way of looking at bonds, the way he explained, right? And I think that that's the way that will eventually rule the market forever. It's always going to be that way. And this 30-year period that we've been in, if you think about the history of debt investing, I mean, it's just a microcosm of it, really, right? So perhaps there is more turmoil. There's going to be more volatility, and there will be a continued discussion about this important trend line break. But ultimately, even like 10 years from now, guess what? It's going to be governments in creating currency, right? And that's going to have an effect on interest rates. And I would just I think that don't fight the Fed rule is going to ultimately last for the rest of our lifetime.
I saw a tweet, Brett, not too long ago, which said, "Don't fight the Fed when they are fighting inflation."
That. I like that even better.
I liked it too. Vijay, I have one last, not really a question, but somebody here on the chat would like to know if there is any good book that you would recommend, particularly for commodity trading. I mean, I know you've written a couple of books on commodity.
Yes, for commodity trading, I believe Carly Garner in the US has written some pretty good books on commodity-specific trading. And Larry Williams has got a couple of very good books on commodity trading, if you can Google search them. There is also the commodity annual yearbook, right, by CRB, a Commodity Research Bureau. That's not exactly technical analysis. That's more of data, right? But the CRB itself has a very good library of books recommended for commodity traders. But Kali Garner, I can tell you, has written some pretty good books on commodity trading.
I think there is something called the Stock Traders Almanac, which is also like an annual publication. I think there is a commodities variant of that too. That's the one that you're referring to. Although I don't exactly know what the title is, but
No,
we can find out.
the CRB annual yearbook is not the almanac. It's not the
Oh, okay.
almanac. It's like your Mumbai telephone annual directory, right?
Okay, I get you. So it gives a lot of historical data rather than snippets
Yes,
on how
yes,
use TA
yes,
is what you're trying to say.
yes,
Okay,
yes.
cool. I think
Akshay, we have a question
Keza,
for Brett, actually.
oh,
So, Brett,
sure.
there's a question for you. What is your view of the growth of technical analysis and the CMT association in the Asia Pacific region?
Yeah, great question. Thanks for asking. Right now, over the last, well, it's hard to quantify because the growth is not linear. But I would just say, at a minimum, over the last 5 years, we've seen very strong demand for the CMT program, the CMT curriculum. And so our test numbers have now reached the point in the APAC region, and especially India, where it's a greater proportion than in North America. And so it's our largest market is APAC. And so the demand for technical analysis in Asia Pacific is very strong, but it's actually worldwide. It's just that it's very obvious in APAC, and in other places of the world, it's growing, but obviously less so. So everything's rising, but APAC's growing faster. So as a result, the association and the board of directors are very focused on making sure that we have the right advisors involved in helping us, like Akshay. We make sure we have the right level of resources. I mean, we manage the association so that our financials, our balance sheet strength, and the payoff from investments is appropriate. So there are capital budgeting decisions we need to make. So we want to make sure we do those appropriately, so all of our investments are good payoffs for the association. So we talk about that a lot, and I think we're doing what we need to do. For example, we just retooled our infrastructure in India so that our office there, run by Joel, can successfully execute on many more initiatives throughout the whole APAC region, and that was a big change that happened over this just last year. So it's really impressive. We want to continue staying focused on doing things right and growing healthily over time, and things like having the right volunteers and the right staff members involved, having great events consistently is going to all lead to both happier members, better content, and just a snowballing of success, I think.
Thank you, Brett. I think India will basically, lead the way forward for APAC to grow, and what I see over the horizon is very, very positive. Keza, do we have any more questions for either Vijay or Brett?
May I add one more thing? I wanted to say,
please.
Vijay, thank you very much. I loved your presentation. I wanted
Thank
to
you, Brett.
add.
Thank you.
Yeah, what I appreciated most about your presentation and your analysis is that it is an exemplary case of what some people in the field of technical analysis call fusion analysis. I know that our founder Ralph Acamporio uses the word fusion analysis to describe this investment, a blending of investment methodologies or philosophies. And often CMT program candidates, or those who are interested in the CMT program, will ask me or others on this call, how should I approach the field of technical analysis for my career development? And I think that they envision that there is this opportunity to become an expert in technical analysis, and that equates to landing a job. And the truth is that throughout the whole field of finance, it really requires that you use it as one aspect of how you understand markets and how you invest. For example, you included an understanding of macroeconomic forces. You also included an evaluation of individual companies' fundamentals, and you also included chart analysis and looking at patterns on charts. So all of those things, including intermarket analysis and charting, all of those things are really required to do an effective job, I think, as a securities analyst. And so that was a great presentation for the content, but also the methodology was really exemplary. I wanted to point that out to people on the call.
I fully agree. I think the best approach is the one that connects all the dots, or at least most of them. And it's also another reminder for everyone who's listening in the classical technical analysis, and particularly intermarket, analysis is never going to go out of fashion. It's been around for a long time, and it's going to continue, being as important as it's been. So on that note, Vijay, thank you so much.
Thank you, Brett. Thank you. I appreciate it.
Right? I was wanting to invite you and get you to talk to us for a long, long time. Finally, it happened. I couldn't have been more thankful, along with the rest of the crew at the association. So on behalf of all of us, thank you so much. Thank you very much for those questions. And we will see you at the next chapter meeting. Thank you, everyone. Have a good weekend.
Thank you, guys. Thank you, everyone. Thank you, Vijay and Brett, for joining.
Bye.
See you all.
Thank you, Vijay.
My pleasure. Bye-bye. Bye.